So I'm Tim Bennett. I'm the was the chief executive of AIX, the ASTANA International Exchange, and am now chairman. I've spent maybe 20 or 30 years looking at capital markets around the world, in particular developing markets. But I'd stress at the outset of this, I am no academic and I'm no economist, and I'm definitely not an academic economist. So when I was asked to do a lecture or a speech on the future of the capital markets, it was quite a daunting challenge. It's a very, very big topic, and what I've tried to do today is to distill down to some reasonably key messages, but at the same time keeping it an audience which, as I describe it, my daughter could understand, who's a lawyer who doesn't know anything about discounted cash flow. So the starting point for this is for all of us to have a reasonably common understanding of what we mean by capital markets. And in particular, what I'm going to talk today about is the public capital markets. So that's exchange-traded markets. So what is a capital market? Well, it's like any other market that you go and buy fruit or used cars. It's a market between buyers and sellers. We call them slightly different things, but at the end of the day, you have a price for a good between a buyer and a seller. In our case, the buyers are investors. They buy assets, or whether they be debt or equity, typically on exchange, sometimes outside of an exchange, from what we call issuers. And those are companies, organisations, governments, regional governments that issue debt or equity securities. And there are two types of trading on a marketplace. There's the primary capital markets, which are what we call the IPO markets. So that's companies issuing new securities to investors. Typically doesn't involve an exchange. And then we have the secondary capital markets, which is what you see every day trading on NASDAQ or AIX. The buy and the sell between investors. I'm going to focus a lot of my discussion around issuers, investors and exchanges. And I'm going to leave off discussion around regulation, except in a couple of places. Not because regulation's not important, but regulation varies around the world. I'm also going to use a lot of data from the United States. Quite frankly, it's the easiest to get. It's the world's largest market. And a lot of the trends we see in the US market, over time, we see in developing markets as well. So to set the scene for the discussion, I've divided the capital markets into three phases of development, if you will. The first is a time frame before the year 2000. And as you'll see, 2000 is not arbitrary, but it's what I call the golden age of the public capital markets. We saw lots of growth in issuers, exchanges changed the way they traded. There's a big growth in types of investors. Things were very good. The period between 2000 until about 6 months ago was good if you're an investor because the price of securities went up across the board. If you're in the markets in 2000 through the end of 2020, you made quite a lot of money. So while the market grew well during that time frame, if you're a participant in that market, if you're a broker or an exchange, or to a certain extent some issuers, actually it was not very kind to you. And I'll tell you the reasons why in a moment as we go through that. But in my view, we saw a decline in the public capital markets over the last 2 decades. And of course, I'll talk to you a bit about what's next. What were the glory days or the golden age of the capital markets? It's going back to the 1970s. It became almost like a status symbol in the US to list your company. If you wanted to raise some capital, you'd go to the New York Stock Exchange, you'd list, you'd ring the bell, you'd have a price on your securities. And by and large, actually, a lot of family businesses continued to control their business, but they had a public security that they could raise new capital. They could have a price for the security if they wanted to sell. But it was a mark of achievement. It was a corporate milestone. The other thing we saw from issuers during that time frame was a continued growth in public debt issuance. So historically, companies had lent money from banks, but over that time frame, you saw the increasing use of the public capital markets. So people issued corporate debt, to institutions in particular, but also to retail investors. The investment landscape changed quite a lot as well. In the mid-70s, the US changed the regulations around commissions on trading. It used to cost about $125, by the way, in 1970s money, which is a lot more today, to execute a trade on the New York Stock Exchange. Charles Schwab fought hard to change that regulation and launched discount broking. So retail participation in the markets increased. Institutional investors also got much more sophisticated. They were, by and large funds that didn't really try and outperform the market. But you saw a lot more sophisticated institutions develop during the 70s and 80s. And exchanges changed as well. And I'll come back to this because I think we are going in some ways the full circle. But a lot of exchanges in the 70s and 80s were mutuals. They were cooperatives. They were owned by a combination of the regulator, brokers, and sometimes the government. And they were largely national exchanges. So they were raising capital for companies in their local market, and they were all incented to create an ecosystem of brokers, investors, and listed companies in the local marketplace. But towards the end of this time frame, for some very good reasons, exchanges started to demutualise. They became for-profit, they became public, and they listed on their own exchanges. And their incentive changed from focusing on developing capital markets to returns to shareholders. And the first part of that was good. It was good because they became innovative. They changed the way the markets operated. They provided market-making services, for example, or tools to increase what we call liquidity. So liquidity is the ability to buy and sell at the market price. The more liquid a security, the easier it is to buy and sell at the market price. They also developed hedging tools, so we saw the rapid development of financial derivatives during this time frame. So if you're an investor, you could start to hedge your positions. And they started to develop new types of listing venues. So the requirements for a company to list. And the best example of this was the AIM market in London, which was targeted at smaller companies and was very, very successful at getting a couple of thousand smaller companies to list and raise capital. And we can see the results of that in terms of the number of listed companies in the US and market capitalisation to GDP. So the blue line is the number of listed companies. It grew quite rapidly towards the year 2000. And more impressively, I think, is market capitalisation to GDP, which is the green line on the right. Market capitalisation is simply the value of all the listed companies, or the equity value of all the listed companies, over the size of the economy, so GDP. And as you can see, these were the golden years. Similarly, when you look at the debt market, if you just focus on the graph on the right, about 60% of corporate debt in the US at the beginning of this time frame was in the corporate debt market. At the end of this time frame was 80%. So companies were only reliant on debt financing for 20% of their needs from banks. So banks were essentially disintermediated in the US market. And we also saw, as I said, the growth in retail trading. Now, if you look at the graph, the orange is the growth in the retail broking business, the blue is the growth of Charles Schwab, which was the innovator in terms of firstly lowering the costs of trading, but then taking trading onto the internet. And around the year 2000, there was about 10 to 15% of trades were executed by retail investors directly on the US exchanges. Now, the important thing about retail investors is they provide what we call price discovery. So if I got all of you to estimate what the score would be in a rugby game in New Zealand next week, the more of you that guess the outcome, the more likely the average is to be correct. It's just a statistical phenomenon. And the same is true of setting prices on the stock exchange. The more investors I have, the more orders I have, the better the price discovery is. And retail investors, even though they're relatively small, provide a high level of price discovery. So in the US markets, despite them being only around 20% of the trading at the moment, they contribute about 40 or 50% of price discovery. So retail is really important to the market. What happened in the 2000s, as I said, is the couple of decades of decline in public markets. Now, as I said, look, someone think I'm crazy saying this because, of course, you invested in 2000 and you cashed out at the end of last year. You were looking pretty good. But the best way to think about this is that the size of investing opportunities grew during the 2000s. The size of the pie increased exponentially. And the public capital markets, or the exchange-based markets, yes, they were a share of that pie, but they were a much smaller share of that pie. And the economics for exchanges in particular, and brokers as well, became quite negative during that time frame. So we saw the decline of the public markets. What was the cause of that? Well, as I said to someone in the audience before, this is probably the killer slide. When I worked at BCG, there was always slide of the year. And this would be the slide of the year, I think. What this shows is interest rates in the US, so the 10-year bond rate, over the course of the last 2 decades. It's the orange line. Went from about 6.85% or 685 basis points to below 1% over the course of that time frame. Now, money is like any other commodity or good. So basically, you can think about the price of money went down dramatically during this time frame. And the reason for that was that the Federal Reserve and other central banks around the world wanted to stimulate economic growth. So the cheaper the cost of money, the more economic growth you got. And that was fine for the first part of those 2 decades, or the first decade. And then we had the global financial crisis. And the Federal Reserve decided that it would, quite frankly, print money through a process of what's called quantitative easing. And QE effectively put more money into the economy. And what the blue line shows is the monetary base of the US. It's the amount of money in circulation. I won't go into details about how they did that, but it's not quite as simple as printing money because money's paper. But they created electronic money. So during the financial crisis, they doubled the money supply. And then a couple of years later, they decided that wasn't enough, so they doubled it again. And they didn't start to tighten or quantitatively tighten until just before COVID. So when COVID hit, I thought, oh, well, here we go for another recession. So we'll double the money supply again. So over the last 10 or so years in the US, and it's true for most developed economies, you've had money supply double, double again, and double again. So if you think about that in a physical goods market like used cars, rather than having 5 or 10 used cars for sale, you suddenly have 40 or 50. And the price of those cars has dropped dramatically. Now, like cars, money can't disappear, that it exists. And so what you saw over the course of these 2 decades is the development of different types of asset classes. Well, first thing you saw is, of course, prices went up. So those of you who know discounted cash flow, interest rates go down, equity valuations go up. But that wasn't sufficient. You also saw the development of new asset classes. And I'll come on to some of these in a moment, but private equity, crypto, all sorts of different investment opportunities. So the exchange share, or the publicly traded share of this market, declined. And just a couple of examples of this. This is private equity. This is McKinsey data, and this is money going into private equity funds over the last 10 or 15 years. 2017, around $1 trillion went into private equity funds around the world. Global IPOs only raised 200 billion, or 0.2 trillion. So 5 times the amount of money went into private equity as it did into listed companies, or at least newly listed companies that year. Last year was a bit different. We had a great IPO market globally, around $600 billion raised globally, and about 1.1 trillion, still around double, went into private equity. So private equity became a force that has shaped the public capital markets over that time frame. The second thing that happened is, and this is good for investors, but not so good if you're a broker or an exchange, is you saw the rapid growth of exchange-traded funds. So in the 70s, well, more like the 80s and 90s, you saw the development of mutual funds, or as we call them here, unit trusts. And you typically pay about 1% management fee to those unit trusts. And exchange-traded funds, and they're harder to buy and sell. Exchange-traded funds, you can buy and sell on an exchange easily, and fees are low. In some cases, 7 bips or 0.07%. So what that did for exchanges and brokers is, of course, there's less money, so your profitability declines. So while this was good for investors, that certainly wasn't good for the exchange landscape. You also saw towards the end of the last decade the development of free trading in the US. So Robinhood in particular started out in 2015, and again the blue shows the growth rate here versus the orange, which is the growth of the industry. So Robinhood grew exponentially. Every broker in the US of any size now, you can trade for free. Now, trust me, it's hard to make money when you trade for free if you're an exchange or a broker. You make it in different ways, but it's very hard to make money. And the second thing that happened is the development of the crypto market. And while I don't want to give a lecture on crypto, it is clear that a large amount of money went into cryptocurrencies over the last 5 or so years. The market value of those was, until a couple of months ago, $3 trillion. And again, to put that in some context, that's $3 trillion versus the 600 odd million in the IPO market last year. So not surprisingly, you saw a decline in the number of listed companies, which is the blue, and a sort of flat market cap to GDP ratio on the right. There are a number of other factors about listed companies, the decline in those. Obviously, some of them got sold to PE, but also the US changed a regulation, an act called Sarbanes-Oxley in 2002, and made it harder for companies to list. So companies didn't do it. They had alternative sources of capital. And what happened to exchanges, and bearing in mind that exchanges are the heart of the capital markets in lots of ways, is they changed direction. The first thing they did is rather than becoming local exchanges, they started to globalise. So NASDAQ bought OMX, which was a group of European exchanges, 2007. The London Stock Exchange Group bought Borsa Italiana in 2006, I think. The New York Stock Exchange bought Euronext in 2006 as well. So you started to see these large global exchange groups were less concerned about local capital markets, but how they can make money globally. And then finally in 2012, the last big transaction was a derivative exchange called AIX bought the London Stock Exchange and the Euronext group as well. So exchanges became less of a national asset and a technology company. So if you look at the graph, probably hard to read, but equity trading, or cash trading as we talk about in the industry, somewhere between 10 and 20% of revenues for those big exchange groups at the moment, and probably a lot less of their profits. NASDAQ's in technology, London Stock Exchange bought Refinitiv last year, ICE makes a lot of money out of derivatives. So all in all, you would say it's a pretty bleak picture for the public capital markets. If you can't list companies, you can't serve investors, and it's very, very difficult to see how exchanges survive. However, of course, in the last 3 months, and I'd arguably say we saw the writing on the wall over the last year, is the circumstances globally have changed. Interest rates have gone back up. Well, maybe not. Interest rates have gone back up and will continue to rise. And Jacob Frankel gave a pretty harsh assessment of what that will do to the global economy this morning. But what is also clear that it's had an impact on valuations. So the right-hand side here is the 3 major US indexes decline since the beginning of the year. But it's not only the public capital markets seen this decline, it's also the private markets as well. Private equity valuations are coming down. We've seen a sharp decline in valuations of crypto. The reason for showing this is to say a lot of the drivers of what happened in public capital markets over the last 2 decades don't exist anymore. So the question is, where do we go from here? And the first thing I'd say is we're in an environment where capital is much more scarce. And that's kind of an industry term, but really it means money's harder to come by. So if it was pretty easy to get capital for new businesses over the last 2 decades, obviously the cost of money is going up and the availability of that money will become more scarce. I also think we're going to see a relatively long bear market, which means that stock prices will be pretty flat over the next 1 to 2 years, hopefully not declining too much. And we're also starting to see a regulatory response to new asset classes. I'll come on to that in a moment. But there are some things that we've had over the last 2 decades that will shape where we go going forward. The first one is retail investors, and this is some data I found from Schwab, but you remember GameStop, and everyone's investing, or AMC Media, everyone's investing 12 months ago or 18 months ago in these meme stocks, and they were trying to make a lot of money out of, quite frankly, businesses that were pretty distressed. You would have thought that the likes of Robinhood investors would have exited the market over the last 3 months. Actually, that hasn't happened. So we've still got this large retail investor base in the US and developed markets that has remained. And that's a good thing. It's a good thing for price discovery, but it's also a good thing for individuals to think much more about how they invest, what they're investing in, what types of companies, and how they're going to save for whatever they need in their life, whether it's a house or for retirement. So that's a good thing that's happened over the past couple of years. The second thing is people often forget that there are 2 types of issuance on the market or issuing new equity securities. One's the IPO, and the IPO numbers are in orange here. Now those IPOs are volatile. Good year last year, not so good the year before, not so good the year before that. But secondary offerings have actually been very, very consistent in the US market, and it's true of other markets, actually more so in Asia than the US. And what that enables companies to do that are listed is to say, actually, I want to buy some new aircraft, I want to invest in some new gas production facilities. I'll just go to my existing shareholders and potentially new shareholders, and I'll issue new shares. And this has become increasingly common, particularly for smaller businesses, as a way to raise capital. It's quick and it's very cheap. And as you can see, that number hasn't changed much through the economic cycle. And the third thing, which if some of my capital markets colleagues were here, they'd say is more controversial, is we're going to see much more regulation, and that's a good thing. Singapore announced last week that it's going to start to regulate crypto exchanges like stock exchanges. The SEC is apparently also planning to do this as well. We've also already seen the SEC say that they want to regulate secondary trading in private equity funds the same way they regulate public securities. And we're also starting to see, I think, an investor concern about the types of leverage trading you see, particularly in crypto, when you thought you were earning 18% on some Dogecoin, but in fact you can't actually get your money out when you need to get it. So there's both going to be a regulatory push, but also an investor push to have much more orderly and regulated markets. And unusually, I would say for me, that's a good thing to have more regulation. I can hear my AFSA colleagues laughing in the background. So where does that lead us in terms of the capital markets going forward? Firstly, we know what investors want now. And I'm talking about people like you and me who are retail investors who really want to get on an app and buy something. But I'm also talking about institutional investors who want to get on their screens and buy something. And I call it press the button and done. You don't really care what exchange that gets executed on. You don't really care what broker you use. All you really care about is when you're going to buy or sell something, you can do it. And that's where we've got to. And the exchange is the heart of that ecosystem. So when you trade on IB or Saxo or Harlech, it's executed on the exchange and you don't even know. The second thing, as I said before, is there's going to be more of an appreciation of the value of regulation. People in an uncertain environment want a bit of certainty, and regulators provide certainty. You want to know that the broker you're dealing with, the exchange you're dealing with, the ETF provider you're dealing with is well regulated. And the third thing I think you'll see is investors thinking much more about what they invest in. So, for example, we know from the meme stock era that lots of people, and we see this in Kazakhstan, lots of people invest in Apple, Tesla, etc., Netflix, because it's a product they understand and they use. We also see this growth in exchange-traded funds, which are also products you can easily understand. And I think as one of the panellists said earlier on the day, you're also seeing a lot more local IPOs being bought by local investors for the same reason. Kazakhs will invest in ASTANA because they understand ASTANA. They understand Kazakhstan. So, and that's what we've seen in the Middle East over the last 3 months as well. Local investors understand local businesses better. So what does that mean for exchanges and by extension, the public capital markets? Firstly, I think we see a shift back to exchange-based trading. both of equities and debt securities that are currently traded off market. And you've seen a lot of regulators force this over the last couple of years. But I also think you start to see different asset classes being traded on exchange. Private equity secondary trading on private markets first, but then onto exchange-traded markets. You'll start to see crypto become an exchange-traded product as opposed to a product that's traded somewhere you don't know about. You'll start to see carbon being traded more actively. Now, carbon credits are just like any other security. You can trade them on exchange, but they provide a price for emissions. And as we move to a zero carbon future, of course, the easiest way to do that, not that it will be easy, is to put an economic cost or a price on emissions. And we're also going to start to see more mutual funds being traded on exchange through active ETFs. One of the largest mutual fund groups in the US, Dimensional, has just started to do that. So we're going to see a lot more exchange-traded products because you can push the button and get it done, and exchanges are by their nature well regulated. I also think, probably more controversially, that you'll see a resurgence in what I call national exchanges. You know, AIX is a national exchange, SGX is a national exchange. We are concerned about the development of the local capital market. And in a world where capital is scarce, governments will be particularly keen for the local exchanges to perform their role in helping local businesses raise capital. In a lot of ways, it's the same as some of the discussion today about supply chains and resilience. We used to rely on global supply chains. Now we're investing in local supply chains and local manufacturing because we want to be sure that we can get goods for our people quickly. Same thing is true of exchanges. You start to less reliance on offshore exchanges and more reliance on domestic exchanges. And for many years, Kazakhstan has relied on raising capital in London, and it's not gone very well. And a lot of you don't invest in Kazakhstan, you invest offshore. So my final set of comments is around Kazakhstan and what does it mean for the development of the capital markets here? Well, firstly, and we've said this from day one at AIX, is we need to have a national exchange. We need to have an exchange that raises capital for local businesses. Why do we need to have this? Because capital is what greases the wheels of economic growth. And particularly as capital becomes more scarce, it's going to be much, much harder to get that capital. Much harder to get it out of London than it was historically. So particularly in the geopolitical environment we're in at the moment. The second thing is, of course, as a country moves to a more socially inclusive economy, capital markets are a great way of sharing the ownership of businesses, whether that be through a privatisation program that Kalev talked about today, or whether that be through employee ownership stakes in businesses that they work at, for example, Caspi's employee ownership scheme, or whether that be through a pension fund that invests in local assets rather than offshore assets. So I think there's a bright future for the capital markets in general, but particularly for national exchanges, and that's what we need to achieve in Kazakhstan. For those of you who know me, you realise that I come to ASTANA or Nur-Sultan every couple of months, and every time I come here, I get off the plane and I'm feeling a bit despondent. I came here in February, and for obvious reasons, you know, there's a whole lot going on both here and in the Ukraine that you think, oh my God, what have we got into? And the same was true when I arrived the weekend before last, is, you know, the global capital markets are in a bit of meltdown. Not only equities going down, commodities are going down, and bonds are going down. It's hard to find any bright light. But when you come here, you realise, and you would have seen this today, there are tremendous opportunities in Kazakhstan, a multitude of opportunities that we talked about today. But the key to unlocking those opportunities is to have a vibrant capital market. And if there's one thing you take away from today's discussion, is that we need to have a vibrant capital market in Kazakhstan, and that will help support the economic growth here. Thank you very much. Right, I've probably talked for too long. I'm happy to answer some questions, probably outside, when I step off here. I have been asked to remind you that there's an unveiling of a bull in front of this building shortly. I asked you all to go along and take a selfie with the bull. Maybe that'll have some impact on the value of the market tomorrow, who knows? But we can always hope. Hopefully it's a good omen for the capital markets going forward. So thanks very much, and have a good evening.